In this discussion, which will last less than 15 minutes, I intend to share with you my market outlook views and also explore some major investment themes relevant to 2021. My feeling is that right now, we live in the best of times and also the worst of times. By which I mean that I think in the short term, this year and next year probably, we continue to live in a very attractive environment for investing. But I'm really worried about the medium term, let's say 3, 4, 5 years from now, when I fear that many of the problems that we are storing up now for the future will really come and attack us. Let me elaborate. I think in the short term, the investment environment is very attractive. By probably the late summer or the autumn, with the introduction of vaccines, we should have regained a degree of control over the coronavirus pandemic. In the meantime, central banks remain committed to very friendly policies on low interest rates. In major economies around the world, we are seeing that real interest rates are in fact negative. And recently, even the Chinese authorities promised that there will be no sudden U-turn in their support for the economy and the markets. Governments have been using huge fiscal stimulus, borrowing money to support consumption and support families. They've been hurt by the pandemic. So you have a very stimulative, very supportive programs in place, and you have good investment sentiment. I think last year in 2020, many people feared the worst. They thought they would lose money. But in fact, the outcome is much more complicated. We have what amounts to a K-shaped recovery, where certain industries like finance were in the upper part of the K and experienced quite a good year. Markets were buoyant actually. And other industries like travel, hotels were in the lower part of the K, so they had a bad time, but they did receive huge government support. Overall, the combination this year and probably next year as well of economic recovery, pandemic under some degree of control, and continuing stimulus and low interest rates will attract investors into the market and keep them there for the time being. I expect that right now is still a good time to be investing in equities. Now, what worries me is more the medium term, meaning 3-5 years from now. By that point, I think the slack in the economy will be taken up. That means unemployment will have returned to normal levels. And then in the meantime, we'll be seeing the negative impact of the world's withdrawal from globalization, which through massive supply chains and efficiency gains have helped so much to keep inflation under control. That element is going to be much reduced. And I think by then, the huge, or some might even say overly stimulative policies will have created possibly fears about inflation, fears that interest rates will have to be restored to more normal levels. And given the huge debt levels that have appeared in many countries of the world, there are also limits to how much more stimulus governments can undertake. At which point, I think many investors, very possibly including me, at the first sign of a reversal, of a tapering off of QE, will be tempted to take money off the table. We have made a lot of money, we would like to lock in our gains. And if many people do that, you create a huge market setback, even possibly a financial crash. So that's the part that I would say best of times, worst of times. Good now, maybe bad later, quite possibly. And this situation has been further exacerbated by the growing level of social unrest around the world. Let's face it, in this late stage development of the capitalist system, we are seeing the appearance increasingly of very unhealthy practices, including a form of monopolistic capitalism, where large companies dominate everything. Winner takes all. This makes it difficult for small and businessmen to survive, and even for innovation to really take off. And on top of that, you have growing politics and the politics of tribal identity. You have polarization in many societies. We see that in the UK with Brexit. We see that in the United States. Here are some examples. The world turning its back on free trade and globalization. The inability to protect and stabilize, for example, the US dollar. The US dollar is constantly now subject to actions that tend to debase its value. So the trend of a falling dollar may stay with us, and is very, very difficult to handle because there's no other replacement for the dollar as a reserve currency. We will see continuing geopolitical tensions, for example, between China and the US, and a growing emphasis by populist politicians, not on production of wealth, but on distribution of wealth. And financial markets, we are very worried about wealth distribution. It can mean higher taxes and all sorts of new taxes and basic policies designed to take money away from those who have it and give it to those who don't have it. And this is not what financial market gains are all about, frankly speaking. Also, we are seeing a situation where it's increasingly difficult to predict where markets will go because it's the politicians, it's the central bankers who decide whether interest rates stay high or low, which industries are favored, which are not, and how the economic and social system will be adjusted. That's not for financial analysts to say. And yet, this is what will become the biggest factor in determining market direction. So it's going to be a complicated, difficult world for investors in the years to come. So moving forward, what would be my thinking regarding where to put money? I think there are several potential places, but one of the obvious ones, frankly speaking, is just China, because China is the one place where the world before the pandemic continues to be something that is still there for you to see. China was the first in, first out of the pandemic. Last year, it was the only major economy to be able to show growth. The economy grew 2%. This year, China's growth will remain strong. In the first quarter 2021, I've seen estimates that the Chinese economy will recover by the incredible 8% from the same level a year ago. Because a year ago, it was very depressed, first quarter 2020. Overall, China's growth this year, which should come out at something like 8-9%, very healthy indeed. And going forward, most projections show China will continue to be able to grow at roughly 5% a year to eventually become the world's biggest economy towards the end of this decade. And importantly, the Chinese have learned to adjust to the realities of post-globalization. They are now emphasizing domestic consumption, domestic production, their own domestic market, and together with the European Union and the US, China has developed its own, what I call, demand chain. Demand chain is different from supply chain. Supply chain is something like China becoming the factory of the world, the export powerhouse. But demand chain means you have your own domestic market that is able to provide you the engine for growth. Production, innovation, R&D, distribution, brand development, all can happen within your own market without depending on globalization and trade. Now, China has put that together very well, I would say. And so this is extremely important to see the investment opportunities going forward. Now, the Chinese have 400 million people, more than 400 million people in their middle class. This number is expected to double in the next 15 years or so. So there are 950 million people in China who are really have access to internet. So I would expect that the opportunities for overweighting China remains very strong, especially when you see that in the context that foreigners are only beginning to discover domestic Chinese stocks. In the last 20 years or so, when the foreign and Hong Kong investors talk about investing in China, what they really mean is investing in Chinese companies listed in Hong Kong or New York, some in Singapore, some in London. But the story going forward to some extent, will be the story of investing in the real domestic Chinese stock markets in Shanghai, in Shenzhen. This is really the world's second largest stock market. And in terms of trading volume, it already is the world's largest. But the fact is, foreign ownership is only less than 5% in this market. So there's a lot of room to grow foreign money going to China through Stock Connect with Hong Kong, etc. And this will be a big support for Chinese equity valuations. And also don't forget that many foreign investors are increasingly attracted by the rise of the Chinese renminbi. Chinese renminbi, 10-year treasuries in China now, the yield is something like 3.1%. US 10-year bond yield is something like 1.1%. So just by putting money into renminbi instruments, you have a pickup of 200 basis points. That's very attractive. At least interest rates in China remain positive, even in real terms. Then you look at the domestic side of the equation, not the foreign side. Chinese household savings is one of the largest pools of savings in the world, possibly the largest, but it's mainly concentrated in real estate and in money market and bank deposits. That is beginning to change. I think the Chinese government is trying to encourage people not to over-invest in real estate, make another bubble. And also the Chinese government is worried about very aggressive financial market products that are not good for the safety of investors. So you're seeing more and more people shifting their savings slowly into the equities market. At the moment, only 8% of Chinese savings are invested in the stock market in Shanghai and Shenzhen. If that number were to increase gradually, that's a major new source of funds coming into Chinese stocks. And by the way, these stocks are still not particularly expensive. They are trading at a price-earnings ratio of roughly 16 times, 1/6 times earnings, which is roughly appropriate. It's not excessive for the kind of market we are seeing. So I would say that China remains an overweight even in the medium term. There are ample opportunities. CSI 300, which measures the performance of Chinese domestic stocks, I was a little bit worried recently to find that it passed its old high in 2015. But when you look at it in terms of the price-earnings ratio and valuation, it's still reasonable. Because of course, since 2015, there has been a significant increase in Chinese corporate earnings. So the E, the PE has also expanded a lot. Overall, the current environment of economic recovery in China and actually globally is such that in 2021, we are looking at potential for many companies around the world, in China and elsewhere, to increase earnings per share by roughly 25%. So this is a big number and will support my thesis of let's invest and make money during this current short-term environment while worrying about the long term. This leads me to the point that what is my overall investment philosophy? My overall investment philosophy is to be both defensive and aggressive at the same time. I need to explain this. Basically, as a professional investor, as a what I call a quality value investor, which means I emphasize quality value. I don't just buy stocks because they are low PE or high dividend yield, because I think that the kind of value investing now is difficult to execute. There's so much liquidity in the world that if you have a good company with a good entrepreneur, there's no shortage of funds willing to invest in such companies. So that's the trend. So you want to look for good quality companies now as a value investor. Now, anyway, so what I'm saying is that I'm basically very cautious and defensive. But I also recognize that in this current environment, you should try to make as much money as possible when you can do so now. With this favorable combination of recovery, growth, low interest rates, government stimulus, and the worst of the COVID-19 pandemic will soon be over, you have an environment where in the short term, you should be aggressively buying, especially equities, but also including bonds. But at the same time, you know why you should be doing that is that if I'm right, in the medium term, we're going to have a huge correction or setback. You will need to lose money at that time. You have to be able, at that time, to be able to afford to be a loser. And to be able to afford to be a loser, you must be a big winner now, so you can afford to lose part of that money back to the market later. So, but at the same time, of course, my portfolio, I will keep it fairly diversified. I have some diversifiers like gold and some cash, non-US dollar cash. And also, I'm very interested in theme investing, thematics. So, for example, I'm very interested in companies that are good for fighting climate change, food security, healthcare, education, you name it. I mean, there are all sorts of themes going on around that will be provide good support for valuations in the time to come. So in conclusion, I will say again, these are the best of times, these are the worst of times. Still a lot of money to be made, but in future, you also need to have quite a bit of money to lose if necessary. Thank you, and good luck.